Welcome to the first quarter 2025 version of the Peregrine Capital newsletter. The first quarter of the year was quite a challenging one, with the high growth and pure hedge funds ending up by 0.1% and 1.4% respectively. If we compare that to the index in South Africa, the JSE Capswix All Share Index was up by 5.5% for the quarter. So further decomposing that specific performance from the index, you'll note that the resources sector was up by 35%. It had a significant rally. In addition to that, you also saw the likes of Prosus and Richemont rally significantly on the back of pretty good performance there and a rally in the Chinese market in general. So while we caught quite a bit of the rally in respect of the Chinese exposure that we had in the portfolio, we do not have much exposure to the resources space. Long-term investors in the funds will notice or know that we are typically tourists in that space and don't really have that much of an advantage playing in the resources sector. Another detractor from fund performance during the period was the performance of the US technology shares, where the S&P 500 came under significant pressure as a result of the recently announced tariffs by President Donald Trump. So then if we cast our eyes onto the macro side of things in South Africa, the government of national unity seems to be wobbling somewhat at this point in time. The budget has proven to be quite a key sticking point between the DA and the ANC in particular. The ideological differences between those two parties have now come to the fore and is making it very, very difficult to pass the budget. Now, in the absence of a pro-growth budget that the DA is advocating for, we do see it very difficult to actually pass the budget in South Africa with the support of the DA. What's worse, I think, from a macro perspective, is that if the budget is not passed, it is highly likely that the DA turns its back on the GNU altogether, which would be a very, very bad outcome for risk assets generally in South Africa. So we would expect your bonds, your equities and your currency to come under quite a bit of pressure. On the international front, we have seen investors reallocate quite a lot of their capital from the US market towards Europe and China. A lot of this has been valuation driven, where those markets were underrepresented in previous years. In the US in particular, we have seen President Donald Trump and his administration very actively trying to balance their own budget. Now, the two mechanisms that they've got in order to do that are, on the one hand, cutting costs very aggressively, and on the other hand, trying to impose tariffs on other countries to ensure that they are funding a portion of the US tax system. So the tariffs in particular is a component that is quite inflationary from our perspective, and I think has really spooked the US market. So if you add those two key components of uncertainty with the fact that the S&P was trading at a multiple of 22 or 23 times forward, a very big premium to the long-term average, the US market was bound for a reset at some point in time. So that is where we are now with respect to the US. Then another key theme that we've spoken about over the course of the last 2 years has been artificial intelligence. And the good news there is that the innovations that have come to the fore in the last 3 months have absolutely blown our minds. They've been substantially better than our wildest expectations. While we are quite optimistic on potential future revenue opportunities, these are less certain than some of the impacts we are anticipating on the cost side for many businesses that we have exposure to within the portfolio. So I have a great anecdotal example from prior experience 20 years ago when I was coding a game for my matric project. And in that scenario, it took me 6 months to code a game, Who Wants to Be a Millionaire, which was a very popular game show at the time, which some of our older users might be familiar with. The gameplay on my game was fairly rudimentary, it was very buggy, and the user experience really wasn't great. What I did yesterday is I was fiddling around with Gemini's new Canvas model, which is a product that's been released by Google. I gave the program a single prompt, and that prompt said, build me Who Wants to Be a Millionaire. The program spat an answer out within 2 minutes. and not just an answer. It had done the entire code base, the entire user interface, and needless to say, the gameplay was substantially better than my rudimentary experiment all those many years ago. So what took me 6 months to do, and where the outcome was pretty bad, it took the Gemini model literally 2 minutes to do exactly the same thing without very much of a prompt, and the gameplay was absolutely miles apart relative to what I had done in the past. So we are very, very excited when we think about what impact this is going to have for companies that employ lots and lots of software developers who form a majority of their cost base. Those companies have the ability to do so much more on the coding side with their best programmers. We've already got indications from 3 of the major US companies, as well as Chinese companies, that over 30% of their existing code base is now written by AI. So the cost side of the businesses, I think, are going to come under extreme pressure, and your margins are going to go up, which is going to be very supportive for growth in your earnings per share. We then have to ask ourselves, what have we done in this past quarter, and how are the funds currently positioned? So if an investor looks at the total net exposure of the pure hedge and high growth funds at this point in time, it looks very similar to where we were in December, not much change. But that doesn't tell the full story as to what's actually happened beneath the surface. So the first major action to call out was the fact that we bought insurance in the form of put options on the S&P 500 index to give us downside protection for our US shares within the portfolio. Not only does that give us the downside protection that we're looking for and hedge our risk, it also gives the portfolio management team significant confidence to engage the market as the share prices come down. So what you will see is we've materially increased our positions to some of the major technology companies in the USA that we've been covering for many, many years. So we're quite excited about the fact that we have that exposure on the table today. The next big change is in relation to China. So what happened this quarter, as we mentioned earlier, is we had this new model that was developed in China called DeepSeek. Now, DeepSeek is a large language model that is substantially more efficient from a cost efficiency perspective relative to the existing US models that we've seen to date. That gave the Chinese market significant confidence, and the share prices rallied during the quarter. We assessed that as being somewhat overdone, and we've materially reduced our exposure to the likes of Tencent within the Chinese market, bringing down our overall net exposure. The final thing is that we have increased selective exposure to companies on the ground in South Africa, where the growth prospects remain really good, and where valuations have actually come down such that it gave us an opportunity to re-establish positions. So we've increased positions in the banking, insurance, and selectively in the retail section of the South African market. As investors are well aware, it has been a very choppy past quarter and difficult to manage. However, we feel that the prospective returns that we are able to generate from the current portfolio are likely to be very, very good given the actions that we've taken. Investors can take confidence in the fact that we are, as the Peregrine Capital team, invested alongside you in our funds. Our interests are fully aligned with your own, and we continue to wake up every day looking for the best risk-adjusted opportunities to maximize your return, while also looking for opportunities to hedge the downside risks that we see within global markets that we play in. So thank you so much once again for your continued trust in our process and on our team, and we will endeavor to do our best to keep the runs on the board and keep things ticking along for you at a rapid clip. Thank you so much.